So whether you're getting your first house, first car, or even that premium credit card, building, maintaining, and even fixing a good credit score is crucial. As I've been looking back on my year, I've noticed there was a short period that had a massive drop of over 50 points, only to slowly start rebounding afterwards, which could have all been avoided had I followed some of the tips in the video today. Which goes to show that no matter how much you're invested in this credit card space, mistakes still happen to all of us. Now, a credit score is measured with a 3-digit number ranging from the 300s up to a high of 850. As you would imagine, the higher the better, and are based off of 5 distinct areas, each with their own mistakes that you'd want to avoid. First, imagine you're treating yourself to a few week-long vacation, business class flights, nice hotels, and eating to your heart's content, and putting everything onto your credit cards, because if you've been watching videos like these, you would know that you can get at least 2% back in value for all of your spend with little to no extra work. Maybe pushing 3% when you're considering cards like the Capital One Savor One. And you had an amazing time. But weeks later, you come back to reality and you notice a notification that's telling you your score has been impacted and negatively. And looking closer, that's where you see a massive drop of over 50 points in a short amount of time. Well, that's what happened to me earlier this year when I made a very major mistake in the amounts owed category of my credit score, which makes up a pretty large chunk of the score at 30%. Basically, as I was enjoying my time putting all of these charges on my card, I wasn't really thinking about the credit utilization changes. Whereas out of my total $117,000 credit limit, I usually range around a $3,000 mark, giving me a utilization between 1 and 3%. But because my trip included multiple people, like my parents who I was covering, as well as a few others that would have been paying me back afterwards, that spiked up my utilization to over 10%, which is way above the recommended threshold, which could have totally been avoided had I kept this mistake number 1 in mind, which is to know in advance that I'm going to be spending more than usual on cards and then make manual payments to bring those amounts down immediately. And that works because banks only report your credit utilization once a month. So if you spend and then pay it off immediately, when those banks report your utilization, they won't see those high amounts of spend, and allowing you to maintain that low credit utilization percentage. And on that note, mistake number 2 is that some people actually avoid new credit cards because they believe they might hurt their credit score. But that's not true in the grand scheme of things, because when you're opening a new credit card, yes, you might have a short-term drop of about, say, 10 points that will just bounce back a couple months later, but you'll also be increasing your overall credit limit for the long run, say $5,000 to $10,000, which would give you more credit limit to play in and then lowering your credit utilization and amounts owed. That's also why you should avoid mistake number 3, which is being afraid of high credit limits. I know some people who want lower credit limits because they're afraid that if someone steals their card and uses it, they won't be able to afford those fraudulent charges. No, that's why we have credit card protections. You may actually want to do the opposite and request for credit limit increases if you're able to do so without cost. Similar to how on Capital One, they allow you to request for a credit limit increase once every 6 months without a hard pull, so only a soft pull that won't negatively affect your credit score. Companies also regularly monitor your profile as well, so make sure to keep your information, especially your income, up to date. Alright, I'm sure we've all had an experience where we're lending money to someone else, either friends or family. What goes on in your mind when you're doing so? I mean, you're not gonna just lend money to anyone. So what's that criteria you're walking through in your mind to decide if you should lend someone money? One of those things might be, have you lent them money before? Or do you know other people who have lent them money before? And of course, how soon and how well were they able to pay all of these debts back? If every time they borrow money, they pay back in full 2 days later, great. But if they have a history of forgetting or even not having the funds to pay people back, then that's a red flag. It's the same in the real world too, because your credit score determines how good of a rate you can get when you're borrowing for your car, a house, or even opening credit cards. And by far the most important thing they look at, covering 35% of your score, is your payment history. Essentially, out of all your available credit, which most commonly is probably credit cards, do you pay your bills on time every time? Being such an important element, the tip here revolves around how you should be using your credit lines and debt in general, and that's to always spend what you can afford. The major mistake number 4 is if you're actually treating this card as a loan because you wouldn't otherwise be able to afford the item. No, treat it as if you were able to pay for it in cash already and you're just using your credit card to build up your credit profile as well as rack in those sweet rewards. And then keep things on autopilot. Go through all of your accounts and make sure you have autopay set up through all of them. That way, if you're following the other rule and spending what you can afford, then autopay will make sure that you're never late for any payments. And those 2 tips is essentially how I've been able to maintain a 100% payment history throughout my entire history. But that's not to say I've never made a mistake or missed a month. Fortunately, credit card companies don't immediately report your late payment to these credit bureaus. They usually give you about a month leeway, charging you the interest or late fees, and only if you're not able to complete the payment in the next month, then they report your late payments to the bureaus. So you do have that small buffer. It's actually something I experienced firsthand when I got my Amex Green earlier this year, where I made mistake number 5, not monitoring my accounts and not realizing I didn't have autopay set up on the card. Fortunately, it was caught early enough. I was able to get the fee waived given it was my first incident, and then not have anything reported to my credit reports. And that's a good habit you want to adopt in general. Even if you have autopay set up, you want to regularly check your accounts to make sure everything's in line and as expected, and that there's no fraudulent charges that you need to deal with. So treat your spending like if you had the cash already. Make sure your autopay is on so you can be sure that you're never missing a payment and you're paying in full and on time every time, and that 100% payment history would be a piece of cake. Alright, so with time comes experience, and that goes for your credit score too, which is why the best thing anyone can do is getting a credit card as early as possible. Even if you're just starting out, have no history, or you're even a student, there's options out there, like the Capital One Quicksilver Secure card, where you can deposit at least $200 and use that as your credit limit in order to build up your profile. Or a student card like the Capital One Saver One that's specifically designed for students. In my case, that's how I got started back in Canada with the Bank of America Student Price Card. And that's because having your own credit line and starting the clock on your length of credit history plays an important part of your credit score, taking up about 15%. More specifically, it looks at the length of time you had your accounts open. Say you had 3 credit cards, one with 8 years of history, another with 3 years, and your last one with 1 year of history. On average, that means you have a credit score age of about 4 years. On top of that, they'll also note down your oldest card and newest card, in this case 8 years and 1 year. And that's why it's so important to plan out your credit card journey, because if you make mistake number 6 and get an annual fee card as your very first card, then at some point have the debate on whether or not you should cancel the card to save on the fee, but possibly affect your credit score, though maybe not immediately. Whereas if you started with a no annual fee card, you can essentially keep that card open forever for free. Though it is worth noting that some cards allow you to product change to different cards in the same family, sometimes to no annual fee cards. So say you open the Chase Sapphire Reserve as your first card, you have the option to product change down to one of Chase's Freedom cards that have no annual fee. Overall though, I'd make sure you have enough regular activity on these cards so they don't get closed for inactivity. Try using different cards for regular payments, like reloading your Amazon balance, your Starbucks gift card, or putting them towards the auto pays on your different bills. I actually learned that the hard way, which led to an closure of one of my old accounts with 8 years of history, until I learned that it may not be as bad as you think. You see, canceling a credit card that was in good standing means that it's still going to be on your report for the next 10 years, and continuing to be used towards calculations that these different credit bureaus do. How that decision may affect your credit score is by canceling that card, you would have a reduced overall credit limit, increasing your credit utilization, which may affect your credit score in the amounts owed category. In my case, this card was one of my first cards, which means the credit limit was already pretty low, having a minimal effect on my utilization, and hoping that by the time it falls off of my credit report, there are other things to make up for it. Either way, kickstarting your credit card journey early will not only help you build up good habits early, but also help your score, which you'll reap the benefits from down the line. Whether it's getting a secured card, a student card, or even being an authorized user with a close one, so they can piggyback you and also give you a boost to your credit profile. Okay, so if you're lending money to someone, but they've been going around to everyone and asking to borrow money, how would you feel? Probably that they really need this extra credit line, or they're just extra desperate, both of which are red flags. Same goes for your credit score. If you're making the mistake of opening credit card after credit card, month after month, over and over, that means these companies will regularly inquire into your credit profile to see what's up, which negatively contributes to the next factor in your credit score, making up 10%, which is new credit. In most cases, if you're opening up a new credit line, whether it be a credit card or a loan, the company will inquire into your credit profile to see how good of a borrower are you. Too many of these inquiries will raise a red flag and make yourself look riskier to the eyes of the lender. And this new credit factor takes into account a few things. First, how many new accounts have you opened and of what type? In the credit card world, you might hear the term velocity, or how some issuers have rules in place to prevent exactly this, like Chase's 524 rule, saying you won't get approved for new credit cards if you've had 5 new ones in the last 24 months, or Citi's 1-8 rule, saying you'll be immediately rejected from any new applications if you've had more than one in the last 8 days. Second, they'll look at your recent inquiries. On the FICO page, it says they only look at the last 12 months, although these types of inquiries will stay on your report for 24 months. And then third, they'll look at how long it's been since you've opened a new account. Again, opening new credit cards can have a short-term effect on your credit score, from usually a new inquiry as well as an overall lowering of the average age of all your accounts. For example, with our 3 cards of 8, 3, and 1 years of age, if we add a brand new card to the mix, that's going to lower the average from 4 years down to just 3 years. But on the flip side, it could increase your score through having a higher credit limit available, which means a lower overall utilization, which is a much larger slice of your score. That, or it could affect the next slice of your credit score, making up another 10%, and that's your credit mix. Now, the reason why this matters is because lenders want to know how well you're able to obtain as well as maintain and handle different kinds of debt. Not just all credit cards and not just all loans. But no matter what the debt is, if you have bad payment history or use a lot of that available credit, then improving your credit mix is not going to help you. Now, from what I've seen, this slice is actually least talked about, but for good reason, because in order to improve this, you have to open up new credit lines of different types. But I don't think improving this slice of your credit score should be the sole reason why you're opening new credit lines. You should only open them when you think you need them. For example, I think most of you watching probably have most of your credit lines from credit cards. You're not going to go out there to open a brand new retail store credit card just to up your credit mix. Nor are you going to pull a home equity line of credit just to do so. This is an area you'll naturally improve upon if you're doing everything else with good habits. Over time, you might get that car, which will trigger an auto loan, or buy your first home and trigger that mortgage. Let those things happen naturally and do not force new credit types. In my case, up until recently, I've only had credit cards as my credit lines, almost 15 credit cards here in the US. But that didn't prevent me from hitting scores in the high 790s. It wasn't until a few months ago that I added a new type, which was my auto loan, but even that didn't see a noticeable difference in my credit score. Now, your credit score might seem like a really scary thing, with so many different tips and tricks you gotta keep track of. But honestly, the system was created to reward people who do the right thing. So if you just stick to the basics of good habits and do that consistently, over time your score will exponential rise. And a great credit profile can unlock so many amazing opportunities, from getting your dream apartment to getting easy approvals for all of these premium credit cards. So you can get a ton of value from those perks and benefits, as well as rack up all those points to redeem for tens of thousands of dollars for next to no cost. So if you want to see step by step exactly how that's done, go on and check out this video over here, and I'll see you over there.